Shilan Shah of Capital Economics joins us from Singapore on the phone line. Thank you so much for joining us. I was reading one of your interviews yesterday, and you'd kind of predicted that if inflation goes up, then we're unlikely to have a dovish RBI governor and bond yields will start picking up. Is that view, are you holding on to that view? Has that view got strengthened further?
Yes, I think so. So I think markets had perhaps anticipated that we would see a more dovish candidate as the new RBI governor. There was some talks of some quite dovish candidates from within the government taking over from Governor Rajan. Now I think that the appointment of Urjit Patel actually signals policy continuity at the RBI. Mr. Rajan was, of course, regarded as something of an inflation hawk, and I think it's the same and it will be the same under the leadership of Urjit Patel as well, which is why we've probably seen a slight rise in bond yields as investors have scaled back their expectations of further cuts to the repo rate. On top of that, as you mentioned, inflation is now creeping above target already. While we don't think we'll see a sudden surge in inflation, we do think it will be hard for the RBI to meet its targets, all of which really suggests that we won't see any more rate cuts in the future.
What does that mean for fund flows into India?
Well, it's a difficult one. I think at the short end of the curve, we're likely to see further slight pickup in bond yields. But over the longer term, you could argue that the appointment of Urjit Patel should be very positive for flows into India. I think because inflation's been the bane of the economy for many years, and I think as an investor, what you would like to see is someone who's still very tough on inflation, and then that should support flows further down, in sort of years to come. I think. In terms of what it means for equity flows, I guess it's a bit more difficult to predict. Banking sector stocks had, of course, rallied prior to the announcement of Urjit Patel, perhaps on hopes that interest rates would be cut again. That doesn't seem to be the case anymore. But I think the general picture for equity flows is that valuations are still looking quite favorable, and so we should see a slight rise in equities over the coming months.
You did mention that Governor Rajan was seen as a bit of a inflation hawk, and Urjit Patel perhaps seen as even more an inflation hawk. Whatever was done by the RBI for the past 1 year, or more actually, doesn't seem to have had any impact on food prices, and that is what spikes inflation. So why should continuity in this case be positive?
No, you're right. I mean, food inflation in India especially is notoriously sticky, really. There were hopes that a stronger monsoon season than we've seen in the past couple of years might actually help to stabilize food prices. That doesn't seem to have been the case at the moment. And given that the weighting of food prices in the CPI basket, it's difficult to see inflation really falling to target anytime soon, I think.
No, that's what I'm saying, that as a person who's sitting in Singapore watching India, why would you think that this continuity is positive? Because, one could argue that food prices are not in the control of the RBI simply because no one borrows to eat. No one at least does not borrow from banks. If poor people are borrowing, they're probably borrowing from local money lenders, and that is not governed at all by what signals RBI sends. Now, effectively, by keeping its core inflation target even lower, because food inflation it cannot control, the RBI is pushing down growth.
Well, I think there's a bit more to it than that. I mean, one thing is that the RBI has never really claimed to only target core inflation. I think it realizes the importance of food prices at the moment and what impact that can have on inflation expectations, not only with regards to future food prices, but also in terms of price levels more generally. Now, the risk, I think, would have been that the implementation of a more dovish governor would have perhaps turned something of a blind eye towards that and maybe cut policy rates a little bit too low, which would have fed into inflation expectations further down the line. And then, in 1, 2, 3 years' time, you can't really predict these things, but we would have seen a sudden spike in inflation back up to the rates that were really holding back growth, and also were a big fear for investors, in the rates that we saw kind of from 2010 to 2012.
No, again, I just want to understand how you're analyzing this, because let's look at India as the kind of capacity utilization India has. In its mid, 70% is broadly accepted. Now, the fact is that if demand is constrained and a dovish governor had come in and given a fillip to demand, then capacity utilization would have gone up, operating leverage would have gone up, and there is no reason to believe that if operating leverage goes up, then that is inflationary, because the unit price of goods actually tends to fall when operating leverage goes down. And therefore, even if corporates do not pass on that drop in unit cost, right, their margins expand, they're able to employ more people, and prices don't necessarily rise. So the argument that dropping interest rates, especially to push consumption, doesn't really hold, that's automatically going to lead to inflation.
Well, no, I think that's perhaps slightly misguided. First of all, there's maybe some evidence that capacity utilization is a bit low, but there's also some suggestion that firms are operating at close to capacity as it is. It depends on which sectors of the economy you're looking at. On top of that, like I mentioned, I think the important point when it comes to inflation expectations is what is happening, A, to food prices, and B, to official policy rates. I think if we had seen rates cut too low, then that would have fueled inflation expectations, and that could be a problem down the line. As things stand, I think...
Inflation expectations for whom? Because the RBI argues that they do the survey of households, and food prices determine inflation expectations. Food prices repeatedly in India have been proved have nothing to do with what the RBI does. So if inflation expectation for households is determined by food prices, what difference does a rate cut make to that?
Well, I think
I'm talking about the RBI's own data.
Yeah, my point is that food inflation does impact, is very much important in the RBI's thinking. And I don't think it's ever said anything otherwise.
No, I'm saying that what the RBI does makes no difference to food prices. I'm saying that the RBI has said that we are looking at CPI, we look at, and inflation expectations are driven by CPI. That's a fair point. But if food inflation cannot be controlled by what the RBI does, it is effectively saying that there is perfect knowledge in the market right now, and people, what we do determines what inflation expectations are going to be, which goes exactly against its own survey data. Therefore, I'm coming back to that argument, asking you that same point, that is continuity good? You think continuity is good in this case, or you think continuity there should have been a disruption?
No, I think continuity is good, and I can't see any reason to change that view. Food inflation very much comes into the RBI's thinking, whether it has an impact or not. I think it does have an impact through inflation expectations.
All right, I think we kind of got your point there. Thank you so much for joining us. Pleasure talking to you, Mr. Shah.